This is Rod Kusin and Spooman for Risk on May 21st, 2010. The purpose of our video today is just to explore some of the variety of different ways that we can set up the risk tick strategy, which is really a tool that can produce multiple strategies on any one chart. On the chart that is producing this specific equity curve, however, we only have two strategies that are running on this chart. And this, through the course of the day, you can pretty well ignore this reference to 518. It really doesn't go back that far. This is just for today, just for the 21st. There are no other trades that are being produced. That's the 518 is in reference to how far back the data goes on that chart. But the strategy trades are just for today, as is the case with any of the equity curves that we're about to show you. So depending upon how many strategies we have on each particular chart, we're going to get a variety of different trades. Some charts will produce far more trades than others. For example, on this chart that is producing this equity curve, you see almost 200 trades. Now that's far beyond what we would normally be looking for. I personally trade maybe 3 or 4 times a day. That's it. But the strategy or strategies may be pulling any number of additional trades. Here's another strategy. This is actually a single strategy on one chart that's producing these results. Here we have several strategies on one chart. And again, the same here. And then finally back to where we were before. So let's talk about this particular strategy that's producing this equity curve. Now the two strategies that we have running on this chart are in fact extremely simple strategies. So we're just going to show you some of the trades that it took. We have it set up as a swing trading platform. There's no particular profit target on this strategy. And you can see some of the trades that it took. Here's about a 5-point move before the reversal here at the bottom. Group reversal, that is. Let's get it over here. Another set of trades here. Long trades, short, back to long. Here this trade pretty much got stopped out, even though we had several points on the board. Once we have at least a point to a point and a quarter, tightening the stop to break even is normally what we would do. But we're just showing you the raw trades here to give you an idea as to where the trades are taken. And we're still live. Now what we like about this particular strategy is that even if we decide not to take a trade, if the market moves further against this particular signal or set of signals, we'll generally get an even better trade thereafter because of divergence. So for example, the trade here, the setup took place here. Just a few minutes later, the market moved a little bit higher. And as it moved higher, it actually produced a better trade. we were no longer hitting the specific settings of this strategy. And as hard as that was to do, now as the market moves higher, we know that that particular price would produce a divergent pattern compared to the strategy setting here. So we may have another strategy that will pull trades over here. Let's look at another example. Here, for example, we don't have a signal here, and the reason for that is that the strategy settings are not being met. In fact, the settings that would produce a trade at this particular moment and in that price range would imply that there is a further divergence. So that's why we'll have more than one strategy working on a particular chart. For example, that trade right in here, right here, if we compare that, well, we don't really have something to compare it with right here, but it's a slightly different strategy and produces a real nice opportunity for a long trade for a few points. It's a slightly different setup. Now here, for example, we have several signals that ultimately get stopped out if we didn't pull a stop to break even. But here, it's right on the money. Here, these two trades here are very accurate. I'm just looking for another. Yeah, here's a good example. We went higher. We didn't get a signal off of this strategy, but the higher price indicated to us that really it's a better opportunity now to trade than it was before, even without a signal, because the circumstances that were pulling these trades has now reached a divergence here. Now, to explain what we mean, I'll put it in a very simple format for you. So notice the trade is taking place here just before 9 o'clock, and then we go higher at around 9:06. So now let's notice our two indicators here, a stochastic and a DPO, Detrended Price Oscillator. Here at this high, where we had the initial the initial sell signals that took place right in here. Notice where the DPO was, here compared to here. Now the value of the DPO there, let's get it, can't really see it on the screen here, but it's 14.18 versus 12.20. So there was an obvious divergence here on the DPO, higher high, lower high on the DPO. More divergence here and a better trade. Very easy to read. So that's why we have other strategies working on separate charts that will also pull trades when we see more evidence of divergence. So here's another one of our charts where we have the initial signal right in here, but a subsequent signal over here, which you didn't see on the other chart. But very, very good trade. Now, if you'd like to know more about how we set up our strategies, you can click on our PowerPoint on the home page of our website for further information. So we invite you to come to our website at RSKsys.com. Call us, ask for a demo, comment on our videos. We'd like to hear from you. This is Rod Kusin and Spooman for Risk.